Welcome back to another episode on the channel. So in today's video, we'll be looking at the concept of divergence, and we will also look at some real life examples. All right. But before we do that, we need to understand what the meaning of divergence and convergence is. All right. Now, divergence, this occurs when the price of an asset and a technical indicator such as stochastic oscillator move in opposite direction. So if you have the price of an asset moving in the, in one direction and indicator of choice moving in another direction, we call this divergence. All right. Now, similar but opposite to divergence, we have convergence, and this occurs when the price of an asset and a technical indicator such as the stochastic oscillator move in the same direction. So when you have the price of an asset and the indicator moving in similar direction, we term this to be convergence. All right. Now, how do we spot these differences in direction of price? We do this by using any momentum oscillator indicator, such as RSI, MACD, or stochastic. But whichever indicator which you choose, you should really understand how to use it, the settings that are required, and everything regarding that indicator. But for me personally, I prefer to use the stochastic oscillator. Now, one thing divergence and convergence will help you with is when price wants to reverse, and sometimes it also shows you continuation patterns. So divergence could spot this price reversals and price continuation when used effectively in combination with technical analysis and candlestick patterns. Now, there are two major types of divergence. We have first the normal or regular divergence, and this occurs at trend reversals. Now, for the normal or regular divergence, you could either have the normal bullish divergence and the normal bearish divergence. All right. And each of these have their own meaning. So for the normal bullish divergence, assuming we have price on a downtrend moving like this, but suddenly turns and continues for a bullish trend. Okay. So we're having a price reversal from a downtrend at this point, reversing to a bullish trend for the trend. Now, for the indicator, we're having price moving in the same direction. All right. But at this point of reversal, you would notice a change in the direction of the indicator. So this is the indicator and this is the price. So what this normal bullish divergence means is that there is convergence between the direction of the price and the direction of the indicator. All right. Once you notice this convergence, it's more likely that price will want to reverse. And most times, this, when used in combination with chart patterns and technical analysis, normal bullish divergence is actually convergence in some sense. Now, for the normal bearish divergence, all right, you have price on an uptrend, then price tends to reverse in the opposite direction and moves in the downtrend. How do we spot when this how do we spot when this is likely to occur? by using the normal bearish divergence, all right? Now for this, we could see that there is actually a divergence in the direction of the price and the direction of the indicator, all right? So what I'm trying to explain is that the normal bullish divergence is actually convergence, and the normal bearish divergence is a true divergence, all right? And this, whenever it occurs, is a signal that the trend is about to reverse. Now, for the second type of divergence, we have the hidden divergence, and it usually occurs when trend is to continue or continuation of trends, all right? So you tend to see this where a trend has already been established, probably a bullish trend or a bearish trend, and price wants to continue in that trend. So this occurs in such scenarios, and we have it's different for bullish and bearish. Oh, and also one thing I forgot to point out is that for a bearish divergence, when looking for bearish divergence, you check the peaks of the price and the peaks of the indicator. While for a bullish divergence, you check the troughs or the bottom of the trend and the bottom of the indicator to search this divergence. All right. So for the hidden bullish divergence, using our example again, we're having a trend that came from downtrend and moved to the uptrend. All right. Now for the indicator, you're having it moving in opposite direction. All right. So the price is in an uptrend, while the indicator is signaling that it's moving in a downtrend. All right. Same with here. So for a hidden bullish divergence, it is a true divergence. Okay. Remember, the normal bullish divergence is convergence, while the hidden bullish divergence is divergence. Now, for the bearish scenario, when we have price moving in an uptrend, then reverses to the downtrend. So, how do we know that price is about to continue in the downtrend after this retracement? We could know this by using the hidden bearish divergence. All right. So this is what it typically would look like for a hidden bearish divergence. You would have price moving in one direction and the direction of the indicator moving in another direction, converging. All right. So the hidden bearish divergence is actually a convergence, while the normal bearish divergence is a true divergence. It's more like an opposite, all right? So knowing these differences will really help you in identifying these divergences. So now let's move to the chart and see some real life examples. Currently, I'm on the Euro USD chart on the 30 minutes time frame, and I have my stochastic indicator pulled up here. So this example is for a normal or regular bullish divergence. So right out the back, we could see that price was in a down push from this zone here. It got down, it pushed up, and went below, broke this structure here and went below. All right. So it began to have some little consolidation here and pushed up, but also you could see that the direction of the market is so, right? But the indicator, which is the stochastic, is in the opposite direction. All right. So you have price moving in this direction and you have the stochastic moving in the opposite direction. Remember that I said for determining the reversals or bullish trends, you use the bottom of the price action and the bottom of the stochastic or RSI indicator, whichever you're using. While determining either the true or the hidden divergence, you use the peaks of the price and the peaks of the stochastic indicator. So we could see that there is a form of convergence or disparity between the movement of the price and that of the indicator. All right. For an example of hidden bullish divergence, here we have the Euro USD on the 4 hours time frame, and price was in an established uptrend and had some little retracement here. All right. So how do we know when price will? How do we know when the end of this retracement has come? All right. We could do this by finding potential bullish divergence, hidden bullish divergence. And right off the back, you could also see that the stochastic was showing price moving in the opposite direction. All right. So there is some form of true divergence here for this bullish trend. So for bullish trend, we find for hidden bullish divergence, we look out for some form of true divergence between the movement of price and that of the indicator of choice. So in summary, this is just a guide which you could use whenever you are trading divergence. So for a normal regular divergence, this is what you look out for in a bullish scenario and a bearish scenario. And remember, it occurs mostly in trend reversals. All right. This P stands for price, and this is indicator. So you look out for convergence in bullish scenarios and divergence in bearish scenarios. Why for hidden instances, hidden divergence, you look out for divergence in the bullish scenario, while you look out for convergence in the bearish scenario. I hope this will be helpful. And remember that you don't use divergence alone, you use it in combination with other key elements that will form your strategy, such as price action, candlestick reversal patterns, or Fibonacci, whatever that you choose, but it shouldn't be used alone. All right. You have to look for other confluences which you can use to support your bias. Okay. I hope this video was helpful to you. And if you liked it, please give us a thumbs up and subscribe to the channel to get more updates about videos we release regularly.